Um, in some cases, emerging companies, startups would demand or desire a level of funding, and that this funding could be provided, by many other means, including venture capital. You know, so in this video, I want to talk about the role of venture capital in startup success, and I will equally discuss the pros and the cons. Venture capital is a form of private equity financing that is provided by investors to startups and small businesses with strong growth potential. Venture capitalists invest in early stage companies in exchange for equity or ownership stakes in the companies they finance. So usually when you bring in venture capital fund, then of course you are bound to probably lose control to a certain limit depending on the percentage of funding you obtain through a venture capital, fund. So these are the key features of this kind of financing. Number one is early stage investments. Early stage investments. So venture capital typically focuses on startups and early stage companies that have high growth potential but may not yet be profitable. Number two is equity financing. In exchange for their investments, venture capitalists receive equity or an ownership stake, in the company, often with significant influence or control. That influence or control will depend on the percentage of capital they are bringing in. The higher the percentage, the higher the control they will exert on the company. Number three is high risk, high reward. Venture capital investments are risky because many startups fail. However, successful investments can yield substantial returns. For those that survive, for those that thrive, they will then tend to cover up or compensate for the losses sustained in the other ones that couldn't survive or couldn't make it. Number four is active involvement. Venture capitalists often take an active role in the company they invest in, providing guidance, strategic advice, and connections to help the company grow. That is what they do. They provide that management skills to the new company to help the company to grow. Number five is exit strategy. Venture capitalists typically seek to exit their investment through an initial public offering, through an IPO, merger or acquisition, where they can sell their shares at a significant profit. Let's look at the benefits of these kind of investing. Number one is or this kind of financing. Number one is access to capital. So startups and early stage companies can access substantial capital to fund growth, development, and expansion. These are things they cannot do. They cannot really obtain ordinarily, but the venture capitalists will come in to fund the company, to give them the kind of financing they will need to survive those initial years without profits. Number three is strategic support. So venture capitalists bring not only capital but also expertise. They bring in mentorship and networks that can help startup succeed. Number three is potential for high returns. Successful venture capital investments can generate significant returns, often multiples of the original investment. Though it might take time, but when eventually the investment is sold off, maybe through an IPO or through an acquisition, you know, the 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 investors in those funds will then stand to benefit. And not only that, there is number four, innovation and growth. Venture capital support innovation by funding new ideas, technologies, and business models that might otherwise struggle to get financing. In a case where a startup entrepreneur may struggle to get financing, then these uh, capitalists will come in, venture capitalists will come in. They call them kind of angel investors. They will come in to provide the needed support. We want to equally highlight the drawbacks of this financing. Number one is a loss of control. Founders often give up a significant share of ownership and control in exchange for venture capital funding. Whenever they come in, they want to exert control, and you will then lose control in the process. Number two is high risk. Many venture backed startups fail, making venture capital a highly risky investment strategy. The rate of failure is always very high, but for those that succeed, fine. Number three is dilution. As more investors come on board, in subsequent funding rounds, the original founders and early investors may see their ownership stake diluted. The more you bring in capital from different sources, the more your stake will dwindle, and the more the founders will then lose control through dilution. Number four is pressure for rapid growth. Pressure for rapid growth. Venture capitalists often push for rapid growth and quick returns, which can create pressure on startups to scale quickly, sometimes at the expense of long-term stability. There's a pressure for quick turnover, for quick profit, and this pressure, may may have a negative, connotation, a negative impact on them, on the growth or the profitability of the company they fund. So we want to look at the venture capital process. Number one is a seed stage. The seed stage. The initial phase of funding are used to support a startup in its early stage, often from the angel investors or early stage venture capitalists. The very initial stage, the very basic fundamental, stage is called, the seed stage. And number two is the series A, B, C, etc., etc. Subsequent rounds of funding that help the company grow, develop its products, expand its market, and scale its operation. So after the seed stage, then the company will still come to raise more funds. You have, stage A, series B, as well as in series C, and then continually, as the case may be. Please subscribe to this channel and like this video. Number three is the exit. The process by which venture capitalists cash out their investment, typically through an IPO, acquisition, or merger. So venture capital is a crucial part of the startup ecosystem, providing the necessary funds and resources to help innovative companies grow and succeed. However, it is also a highly competitive and risky field, both for the startup seeking investment and the venture capitalists themselves. So it's inherently risky. It's risky, but for those that eventually make it, you discover that all things being equal, you know, they would exit successfully.